Now, once we've done that, now we can go back in and look at what changes we've made based on the accrual method, okay? Now, let's look first of all at working capital. Did anybody calculate the working capital? Okay, would you do that for me real quick? Just take the current assets and subtract current liabilities. Now remember that we have 3 current assets, but we should have a subtotal for them, so it should be a very simple calculation. Stacy, what'd you get? 8418? Okay, good. 8418. Okay, there's our working capital. So it hasn't gone down by a lot, but it's gone down by some, hasn't it? Okay. What about our current ratio? What's that? It's significantly different. 2.5. It's 2.5 to 1, isn't it? Okay? Now we are talking the same month as we were doing before, just different methods. We went from a 6 to 1 to a 2.5 to 1. Now is that still okay?
Sure.
Yeah. It's still okay. It's better than the benchmark that we set for ourselves. It just means we don't have as much room as we thought we did. Isn't that correct? In one case, if we had believed it to be 6 to 1 and we wanted to spend $6,000, we might have done it. Okay? If that has still kept us within that 2 to 1 range. But certainly under this, we're going to be a little bit more careful about where we spend those current dollars, aren't we? Okay? And I've added net income to it. Let's just look what's happened. Back in under the cash method on September 30th, the financial statements that we were looking at, it showed $5,649. In October, including September, it's now up to $8,510. What's our net income under the accrual method now? $71.16. So even net income really didn't change. The most significant change here was the current ratio. It's not as good, but it's more accurate. Now, which one do you think the owners want to see? The month's most accurate, because that's what they're going to base their decisions on. Now, their taxable income might be based more upon the cash. But for making decisions in their business, they want to see the most accurate numbers that you can give them. Okay? Okay, once we've made this conversion, we're going to prepare the financial statements. Even though in your book you have 2 sets of financial statements for October, one using the cash method and the other the accrual, in real life you typically wouldn't have to do that. You just produce one set of financial statements using the accrual method. You'd turn that over to the owners or managers of the business or your boss and go through it with them so that they understand it. Once you have done that, you're going to go back to your office and beginning with the first entry in the new month, you're going to reverse that entry. Do you know what reversing an entry means? Doing just the opposite. You're going to take each of those 6 lines that you just made in the general journal, you're going to do just the opposite. Instead of debiting accounts receivable, you're going to make an entry crediting accounts receivable and debiting account 500, adjustment of sales cash to accrual. You're going to reverse it, as though it never happened. So that when you make that reversing entry, what will be the balance in accounts receivable? 0. What will be the balance in accounts payable? What about account 500 and 700? What will be the balance? 0. It will be as though it never happened. Now the reason why we have to do that is because we want to put it back on the cash basis so we can go through this exercise again. If we don't put them back on the cash basis, we're going to be recording the same sale twice. Because what's going to happen next month to all of our sales that we accrued this month? What's going to happen? Next month, at the end of the month, we had 1,088 in invoices, right? In October. What's hopefully going to happen in November? All the customers are going to come in and pay them, right? And we're going to treat them as cash sales in November, correct? Well, in October, we've already recorded these sales, haven't we? And so if we leave them in there in accounts receivable, what's going to happen next month? we're going to record the same sale again when we record as a cash sale. So we need to reverse it to get them out of there, put them on the cash basis again. Then at the end of the month, at the end of November, we're going to go through the same process. We're going to add up all the remaining invoices in here. It might add up to 2,000. It might add up to 500. I don't know. But we'll add those up, and we're going to make the same entry we did at the end of October. Okay? And do those 6 lines. Now, you might say, well, that sounds fairly complicated. Why not just use the accrual method to begin with? Well, it is, especially if we have a lot of sales on accounts. If we've got 3 or 4 customers that are coming in almost every day and writing an invoice, if we want to use the accrual method, then we're going to have to record in our journals an invoice every day, 3 or 4 for all those customers every single day. So let's say we've got 3 customers every day. That's 60 invoices we're going to have to record, right? To use the accrual system. And then we're going to have to record the payment. So that's just accounts receivable, 60 invoices. If they come in and pay all their bills during the month, we wouldn't have to record them at all because they're going to go through the cash register. So this would be just the bills that we haven't yet paid yet. So instead of being 61 entries, it's 6, and then reversing 6. Okay? Perfect example of a great standard entry. Do you remember we talked about standard entries? What are standard entries? They are entries that occur, adjusting entries that occur every month. These 6 lines of entries that you put in is an adjusting entry, isn't it? And so if you set it up in the standard entries journal, you only have to set it up once and then set up the reversing entry the next month. And each month just go through that process. In a computer, we call those standard entries journal, we call them memorized transactions. At least in QuickBooks and most software, that's what it's called. And so you set up this entry once, you memorize it, then all you got to do is go in and just change the numbers each month. And it will be there. And it will remind you to put it in. And so it's really a very simple process to go through. Saves you a lot of time. Now, what is the primary advantage? Save you time. A lot simpler. Can you use this for every company? No. You can only use it for companies that have regular contact with their customers where you're not going to have to send out statements every month. Okay? And that's the cash to accrual conversion process. Let's look at some of the other files that we have in the box, okay? There's a couple files in here that I haven't mentioned, and that is the banking file. This would be for check stubs and bank statements and things like that, anything from the bank that comes, so that it's all together in one place, and then a miscellaneous file. This is for anything else that they might have questions of. And if they have employees and you're doing payroll, I would also have another file for payroll, just so that if they get W-2s, they can put them in there and keep them there and so forth. Everything that you need then is found in one location, whether it be a file drawer in their office or whether it be a client organizer box like this one. It's easy to get to and it's accessible. I've even done it where I created 2 of them for the same client, and then I just switch out, okay? And I'll give them one and take the other one. Then I've got everything, and it's very easy to do that. We're not stopping and having to go through stuff with them, okay? Now, you can't do that with everybody, but it is available. Okay? So that's the cash to accrual conversion process. Can't do it with everybody, but with those businesses that do have regular contact with their customers, it's a very good way to go. The key is if they want you to mail out statements to their customers, it doesn't work. Okay? Because if you're going to mail out statements to the customers, what does it mean? You got to record every sale on account and every payment on account, and that really defeats its purpose. It's only when they have such good contact with their 3 or 4 or 5 customers that they can remind them about payment, when the customers come in, and then they don't have to have that statement. Okay?